Well, hello. Welcome to One-to-One Mining Investment APAC. Delighted that you can join us here this morning for our opening live session. Today we have some fantastic panelists for you to kick the conference off. We have Matt Griffin, who is co-portfolio manager for small caps at AMP Capital. We have Rick Squire, who is portfolio manager at Acorn Capital. We have Hedley Widdup, who is a manager at Lion Selection Group. And also joining us shortly is Nick Farr-Jones, who is a director at Taurus Funds Management. Today we're going to be talking about the appetite for mining investment. When this session was first created, the title of the session was Appetite for Investment Post-COVID. I think there was an assumption that we'd be through the worst of it by now, but we're still very much sort of mid-COVID. So we'll be talking about how the year has gone so far and where our panelists think things will develop going forward from here. Starting things off, 2020, the mining market has actually done pretty well. Rick, if we can start with you, maybe. How's 2020 been for you so far? Some of your successes you've had, and maybe some of the challenges.
Yeah, sure. Thanks very much, Leo. The first quarter is not one that we really want to talk about. It was particularly brutal in March in terms of the speed and the ferocity of the downturn, but. We quickly sort of stood back in early April, and we looked at the setting, and what we saw particularly in gold was actually the creation of what it was almost like a perfect storm, that the Aussie dollar and the US dollar gold prices were near all-time highs, yet the cost base that you're looking at in terms of the two key cost elements are energy, which we're seeing the oil price near all-time lows. And we're seeing the rising unemployment that was likely to follow from the big lockdowns were likely to suppress salaries. And so those two key elements of this cost base were keeping downward pressure on those costs, yet all-time high commodity prices. So we had great success by tilting the portfolio really strongly towards gold in April. And we sold out of a lot of the energy stocks and some of the base metals, and so we've had a very successful 6 months while we position. And now that in the last few months that we've started to tilt away from those gold stocks, where a lot of them, to be honest, are starting to become quite overvalued. And initially it was the gold producers that ran, then it was into the explorers. But now we're finding opportunity in commodities outside of gold.
Typically, what sort of size of company would you invest in at Acorn?
Historically, we've looked at companies outside of the top 250 on the ASX, but we recently won a couple of new mandates and that allow us to invest into companies outside of the top 100. So we're looking at companies, up to sort of $2 or $3 billion market caps, but our focus still remains on the sub billion market cap companies.
Absolutely. And Hedley, you focus very much, obviously, on the junior mining market. How's 2020 been for you?
Well, I think 2020 stands out as being the year that we've almost been waiting for. What's happened in COVID. We've seen the performance in the juniors, which I think a lot of people across the market have been waiting for. And it happens at a time where a lot of the junior companies are restricted in how they can get together and talk about it and talk to the market. They've got to do a lot of it online, certainly can't travel. But the enthusiasm, particularly in the gold space, has come down into the prospective developers and also the explorers. I think over the past 2 or 3 years, we've seen a number of really good exploration things stick their hand up, but it has been hard to see companies across the market raise money. And just this year, we've seen $5-10 million raisings getting away without a great deal of effort, and some larger ones as well, which shows you that there's quite a bit of liquidity there. So, but for the confusion which sort of took place until early April, our portfolio has performed quite well through that time. We've got 3 fairly sizable gold investments, which are all pre-development companies, and they've been seeing, I think you'd say, market favour in the areas where they're listed or trading or behaving. So it's been a really good year, I guess you'd say, compared to the last, I would say, since 2011.
I mean, it's understandable. The gold producers would be successful in this market with gold prices high and costs remaining low. Are you more surprised by the fantastic performance of the smaller companies, the explorers?
Surprised, not so much. It's probably been expected for a period of time. I mean, people will tell you that the gold bull market probably started in 2016. It became a lot more obvious in mid-2019, and here we are in 2020, where we've seen, well, without wanting to go deeply into the profitability metrics, the gold sector has been making money for a while now against a fairly robust price, and that gets recycled sooner or later. But if there are investors there who've made multiples now off of some of the mid-tier to large cap gold stocks, that's when you start to see money starting to filter down. But additionally, I think we've seen enough performance in the gold space, not just the commodity, but the companies, to see pots of money which don't generally delve into smaller things starting to experiment in that part of the world as well. I'm not saying that generalist investors are investing across the board in explorers, but 1 or 2 are starting to dabble and are certainly taking part in the producers, which I would say we have waited a while to see that happen. So this is money coming into the gold space, and as it starts to overvalue the bigger things, it starts to push its way into the more risky things, looking for performance with exposure to the commodity.
Matt, Hedley there mentioned sort of more generalists coming into the market. A&P Capital, obviously, you invest in a wide range of things. When you talk to your colleagues, you must be pretty pleased with the performance of your sector at the moment, compared with maybe some of theirs.
Yeah, that's right, Leo. And I think pretty similar to what Hedley and Rick were saying. Gold has been very good for us this year. There was a period in March and April where the setup was very good for gold equities, in that equities that actually lagged the physical price by a huge amount. There was a massive divergence there, and especially the Aussie dollar for some of the Aussie producers was helping out a lot. So we actually went quite heavily into the gold space towards the end of March and early April, which has paid off. Interestingly for us, like you say, we are generalist investors, but mining and mining related stocks sort of make up 20 to 25% of the index down here. So it is quite an important component. Gold has actually got up to over 10% of the small cap index. So even for generalist investors who don't do much in the way of resources, they're sort of being forced to look at that sector because it is making up a very big part of the benchmark here.
Absolutely.
In terms of other commodities, we probably sold out of the base metals a little bit too early, just on the view that potentially there was a longer recovery to play out. That's probably happened a lot faster than what people thought, just given how strong the Chinese demand has been. I think probably one thing that's almost certain is that this isn't going to be a straight line recovery, and there will be peaks and troughs in this period of the market, just given how much volatility there is going on. And I think some of the other commodities out there which have done very well, there might be better opportunities coming up towards the back end of the year to maybe get set again if people have missed the first of the leg.
Absolutely. Nick, so you've managed to, you've raised another fund, yeah, but you're saying that the travel has been a little bit difficult, so you're more looking at projects in your own backyard. Is that something?
Well, Leo, it's when you sort of put into work, when you've got commitments of in excess of $100 million US. I mean, even if it's a 30-40 million facility, you're not talking about an investment in a junior or mid-cap company. And you can do a lot of that work. When you're talking about debt, there's significant due diligence, technical due diligence, and we often engage ITEs when we're not totally comfortable. We have the in-house resources to look at some of the red flags that projects might have. So it's been clearly a challenge of being able to use independents that can do due diligence, and so it's been obvious for us in this interesting year that we've been looking particularly in Australia for debt opportunities.
Absolutely. Is that something that other people have experienced? I mean, how easy is it to, for example, if you had a project in Africa or South America or somewhere like that, where there might be sort of travel restrictions, how easy is it to get over there and have a look at these things? Hedley?
Well, it's very difficult from Australia. in particular. I mean, obviously, you've got to go through the processes of making application for essential travel, and that's not easy. But then having to be quarantined on return, we're able to, fortunately, we are obviously always looking at opportunities to be mandated on debt facilities. But our current exposure in West Africa in particular, and we've got some exposure in the DRC, but particularly the gold assets in West Africa, we are able just to engage with some people if we need to go down and review the project. But as a debt provider, as a lender, we do receive monthly reports. The projects that we do have commitments to are operating. So it's not like we're chasing a mandate at the moment where it's a greenfields project, going into a project financing. Of course, we're looking at opportunities, but very much a part of the pipeline, and the priority of the pipeline is, what sort of due diligence can we get? So basically, our team, close to 20 investment professionals, Sydney being the head office, Perth, Melbourne, Brisbane, one originator in Europe. Half the team is basically people with lending and finance banking backgrounds. The other half of the team is comprised of people with technical backgrounds. So the technical due diligence team very much looks at what are the orange and red flags, what sort of due diligence we require, are there resources in the country where the project is being developed, and if not, it'll go further down the pipeline.
Absolutely. Hedley, what are your thoughts on the ability to do due diligence?
Well, Nick's sort of lucky that he lives in Sydney there, because I live in Melbourne, and my sister lives 15 kilometres from me, and I can't go and see her. So even going to do due diligence in the next suburb would be pretty difficult, let alone anywhere in Victoria or anywhere else. I won't say there's a way around it, because when you need to put boots on the ground, you either need to go there or you don't invest. And that's the way that our fund works. And I know a lot of investors are like that, but there's ways and means. And I think we're seeing a lot of money flow, which, there are some companies in, let's say, Africa or even Asia, who have expatriate and very good quality local management set up in country. And in some cases, they can help bridge those gaps. I've seen a couple of virtual site visits, which have been very, very useful. It's not nearly as good as sitting in a car with the managing director for a couple of hours and bending his ear. But, at the same time, you can probably get your head around a couple of the issues which you want to. That's not getting me over the line at the moment, but it's certainly keeping me interested in how some things are progressing, and they're close to the top of the watch list because of that. But then I guess there's follow-on opportunities as well. And where we're already invested, that makes it a lot easier, because the due diligence is, the boots on the ground stuff is largely done. Having said that, I guess, we've got experience in something recently where someone needed to do some due diligence on the ground, not for our fund, but in something we were invested in. And they found a locally based ITE who they could invest their trust in for the technical work. And they did a virtual site visit for that group, who were both sort of doing a Zoom over about 6 hours, walking around with a camera. So, some of those things can be done. It's not as good as going and putting your feet there, though.
Absolutely. Going back to the subject of gold, that's obviously been on a pretty good move this year. It's pulled back the gold price has pulled back a little bit in the last month. Where do we think it's going from here?
Well, it's been going up for more than 12 months. And when gold does that, it often goes up and up and up. It's a difficult one, because gold is really hard to value. With something like copper or iron ore, you can probably talk about what the deficit and supply is in the market. And you can take a fairly strong view on what the market would be prepared to pay for those commodities. With something like gold, it's driven so much by emotion and very little by its actual cost in use. As long as the sentiment is positive, then the trend tends to be as well. It's had a little bit of a pullback because some of the factors that were driving it have perhaps settled down a bit. But the underlying fundamental for gold is that real interest rates are very, very low and look to be staying that way for quite a long time. Stimulus is still very high in the major economies of the world. And whilst that's the case, that's a great fundamental for gold. So I think positive, but I'm not going to give you a price, just a lot higher than where we are at the moment.
Absolutely. And at the same time, costs don't seem to be creeping up, do they? And also, we haven't seen any sort of, crazy mergers and things like that. Something that happened, obviously, earlier this week, the merger of Northern Star and Saracen. what's your take, Rick? What's your take on that merger and what they've done there? The fact that it's they haven't really gone for a big premium.
Yeah, sure. It's really interesting. It's out of the sector that we look at, but in terms of the market context, it's an important move because it is the first major trying to upscale and really in the Australian sense trying to compete with Newcrest in terms of the scale of an organisation. And the really good thing about this merger is it has a really strong growth profile over the next couple of years, and that contrasts quite markedly with Newcrest, and so it really differentiates. It gives scale, but also a differentiation with Newcrest, which is their obvious competitor in Australia, and then that will attract overseas investors. So we then look at it in the context of Acorn. We look at, well, what does that mean for the rest of the sector? And I think it certainly opens up the opportunity for some of the other gold companies to look at M&A and the benefits that can come from that, because they are then looking to fill the void that's been created by Northern Star and Saracen exiting. That sure, they're in the top 100, but they've gone quickly through that transition from the ASX sort of 300, 200 into the 100. That suddenly it opens up a void. So where do those investors that are looking for those opportunities come from? So it's really shuffling the pieces on the chessboard. So I actually see it as a positive for the industry.
Leo, if I may, on the same topic, I think it's a fascinating deal because both of those companies have grown quite strongly over, say, the last 5, 6, maybe more years. And one of the features of their growth profiles has been very sensible, deep value acquisitions where they've been able to see value in something and then create it through probably operating discipline is a good factor of that, but also buying stuff which they understood quite well and could add value to. Now, I'm not saying that this merger is not along the same lines because there is definite value involved in putting those two things together and creating a very large and mostly WA-focused business. But this is a change in the character of the deals that those two companies have been prepared to do until now. I mean, this is multi-billion-dollar acquisition, if you look at it that way, for Northern Star. And they haven't been able to say we're buying something for 5, which we think we're going to turn into somewhere between 10 and 100. They're talking about synergies, which are very likely to flow. But this is a big company deal as opposed to the growing company deals which they've done until this point. So I think it's just said that large mergers to create synergies in the market are now okay. Up until now, we've been talking about value-based acquisitions. And I think the value element of this is still strong, but it hasn't been pushed forward as the major part of the argument. So I think it'll be interesting to see how the rest of the sector behaves in response to that.
Yeah, I mean,
yesterday was very welcomed by both sets of shareholders. So obviously there was some sounding out done in the market. And also in relation to assets and synergies, I mean, we were able to participate in a couple of acquisition finances in the last 18 months up in West Africa. Obviously Barrick and some of the majors looking to drop off, not projects which they don't consider to be tier 1 assets. And there's great opportunity, particularly when there's synergies in relation to the location of assets. So, for example, when Terrain were able to pick up the Massacre project off Barrick, and we were able to provide a couple of $100 million of acquisition finance, and when John Wellborn Resolute picked up the Mako project off Toro in Senegal, again, we were able to provide $130 million. That was 50% debt, 50% equity. So again, there's a lot of good synergies and a lot of good opportunities. If they're well thought through, they can be very accretive as far as value.
Because obviously the Northern Star Saracen merger, as you've mentioned, it was all about synergies, all about they've already working together for many years in the super pit, so it made sense. Are there any other sort of obvious candidates out there?
Yeah, that's a good one. It's a different space I see in terms of the quality, and certainly in West Africa you can see some really good opportunities. I think in terms of those larger companies like Resolute and Perseus. Perseus has a incredible growth profile. As they bring on their third operation, and then they go to being a 500,000 plus per annum gold producer. That's massive scale there. That whether they're the target or the acquirer, there are companies like that that I think there are really strong opportunities. In Australia, there's the next tier below the Saracens and Northern Stars. You certainly got those groups, the Regis, St Barbara, Silver Lake, Ramelius, and there's a big step down. So there's certainly opportunity for them to move up into the void created by the Northern Star Saracen departure, sort of, or upscaling really. So yes, there is definitely, because there is that space, and then there's going to be investors looking to get their gold exposure elsewhere, that their mandate precludes maybe the new Northern Star, that they have to sell to move down.
Absolutely.
Yeah, I think I'll just add a comment on that one quickly. I think it's hard to tell where the obvious mergers are. I think this will lead to a lot more M&A in the gold space, though. I mean, there's a couple of factors. Firstly, just how good gold company balance sheets are. The majority of them are net cash, generating a lot of cash, and there's also a lack of a growth profile as well for a lot of these guys too. There's been a big underinvestment in exploration and development over the last few years, which means the growth profile and the growth runway really isn't there for a lot of these companies. Investors don't like seeing mine plans which decline over time, and typically companies don't attract very good valuations on that basis. So I think this will force a hand of a few gold producers to try and add to their growth profile and also just gain a bit of scale. I mean, obviously the GDX and the GDXJ and the other sort of ETF funds out there are becoming increasingly important investors in the gold space, and a lot of these mergers of equal type deals will just get companies to a bigger scale and attract more sort of flow in terms of the ETF and passive money, which can lead to a re-rate. There's never a good reason for doing a merger, but there is a strategic rationale in the short term for doing those sort of things just to gain a bit of size.
Yeah, I mean, interesting you say that once they get to a certain size, it will start to attract, wider pools of capital.
Leo, Matt makes a really good point there, because if you look back in the market, those ETFs didn't exist, say, a decade ago. So if you were to put, and I'll just make an argument based on one example, which I think is a good one. Doré and Silver Lake got together a couple of years ago to create what is now the new Silver Lake. And from the point where that merger was arranged and announced to the point where it was effective in the market, the size of the merged group had actually doubled. So it was a great example of 1 + 1 = 4, and it really did, because that's what happened. And that was a lot of money which had to own it because it found its way into an index, and it wasn't money that was saying this is great value. I mean, perhaps there was that argument, but as soon as it's in the index, if someone needs to own it, that's what they go and do, and it'll re-rate a stock. So that's almost become maybe not a game, but it's a very real opportunity that smaller companies can identify. And I would add that this consolidation to create companies of scale has occurred in Australia. It's occurred largely across Africa, although I agree there's probably some great opportunities left there in gold. I mean, Asia is a very obvious area where that really hasn't been the case, and there's no real sort of Asian gold mining leader. So, perhaps there's opportunities that are based on those concepts which could be explored.
Absolutely. I mean, has this, given that in the last boom, there was a few sort of high-profile mergers which sort of famously went slightly wrong and ended up with CEOs being handed their golden watch or whatever. But has this recent merger sort of maybe taken away some of the fear that CEOs had about maybe they didn't want to be the first to do the bad merger? So now we have quite a sort of conservative merger. This sort of opens the door for everyone else.
Yeah, it definitely makes it okay. I mean, one of the aspects that has to be managed in these things is if two companies come together, there's presumably two CEOs involved. And how do you manage those bulls in a paddock? I think that's been extraordinarily well done for the Northern Star Saracen deal. It sees them all moving into strategic positions, which they'll be very good at. It's not to say that that'll be the case in other companies that try to do it, but it's an issue. And it looks as if this one, first day trading, it has been very successful on that basis. And there's a good reason to think that if they can pull the Super Pit and Fimiston together and show that next stage of growth there, then the merger will have been an absolute success. So people will probably look back on that and say, well, there's a good precedent, makes it okay for us.
Hedley, on that, I think it was the Randgold-Barrick merger that really did set the precedent.
Well, it was copied pretty quickly too, wasn't it?
Absolutely, but just in relation to key positions and
yep.
who would be the executive and the non-executives. And, I think that was the real precedent that was set where there was tremendous value accretion and, it's been extremely well managed.
Agreed.
And so well managed that Warren Buffett has finally delved into the mining space for the first time.
Well, whether it was Warren Buffett or one of his underlings, not sure. It wasn't a huge investment for Berkshire Hathaway, but nevertheless, when you brand yourself as not in gold and suddenly you are, it says something to the market, doesn't it?
Well, I think it's
cost. I mean, obviously, I saw you with Rick Royal yesterday, or whenever that was, and as he rightly said, if you look at the operating costs, if you look at, if you just say the gold price might remain stagnant or it might come off 10-20%, it's still a very well managed, throwing in a lot of cash business. And so I think that's really, it's not a move into gold for Buffett, it's a move into a well managed, good balance sheet, big producing gold company.
Absolutely. It's more about the amount of cash that they're generating. And that actually brings me on to another topic here, which is that, with gold companies generating lots of cash at the moment, what would you like to see them do with it? Do you want to see, more acquisitions, more exploration, or do you want to see some higher dividends?
I might take that one, Leo. I think M&A at the right price is always good. Although, given the run gold companies have had, it's probably getting harder to make pure acquisitions stack up in this environment. There are obviously the merger of equals type deals where there are synergies like Northern Star Saracen, which makes sense. But I would say for a lot of gold companies out there, it's going to be hard to do acquisitions. I think good companies can do both, a mix of dividends, and capital management and exploration. Like I said before, the issue we've had probably over the last 5 years, especially in the gold space, has just been the lack of exploration, the lack of new projects coming through the pipeline. And that really has meant the growth profiles have stalled. And you look out, some of these guys only have a mine life of 4 or 5 years, and then it sort of ends. So as investors coming into that story, you've got to be pretty confident there's going to be a profile after year 5 there. And I really think this is a time where companies probably should be prioritising growth a bit more. The balance sheets that support it, there's funding freely available in the market at the moment. And there's good exploration results coming out. I mean, you look at the likes of De Grey, Chalice, in the sort of PGM space, there have been good discoveries found in this period too. And there's no reason why the majors or the niches can't generate those sort of targets and find those deposits too. I think paying a dividend is a good discipline for a company. It shows they're good capital managers. They will attract funding if they need it in the future. But I think now's the time to replenish that growth profile a bit more.
Mm-hmm. Would you expect some of these smaller explorers to be snapped up therefore by the producers?
Yeah, potentially. And I mean, what we've seen is the likes of St Barbara, IGO Group, they've sort of almost done exploration by taking stakes in some of these small companies. So they're happy to fund these guys with a placement, take a 10 or 20% stake and then see how the exploration goes with a potential view to acquiring it down the line. I think that's probably more likely. You'll see partnerships, small stakes. I don't think anyone's going to be buying just pure greenfield exploration companies. But if there is a good resource and there's some sort of operating or technical expertise which a larger company can bring to the mine development and any potential synergies in terms of processing or shared services, that makes a lot of sense. So I definitely think some of the juniors will be on the radar in terms of getting taken over.
Mm-hmm. Typically, the thing that mining companies can do that explorers can't is they can mine, and they can often bring a balance sheet to bear as well, which is something when you're approaching a development decision can be a difficult milestone to get over for a junior. But the thing which a lot of mining companies can't do is develop projects. So I think that taking over an explorer is sometimes something that they get a bit concerned about, because they know that they're taking on a risk which is more than just, can we mine this? It's can we develop it? And you always get surprises through development. So if you pay top dollar for something which looks like a great project, you might find that the payback is going to be a difficult thing. So I suspect, I agree with Matt's comments entirely. All I would add is that I think that you probably see some of these things get closer to the point of being mined, or at least they'd be funded, so that companies can understand, some of these acquirers can feel like they're buying something which has passed all of the tests. So some of the ones which are at an early stage, it might be interesting, particularly in terms of how they could fill producing pipelines, but probably still have some risks to cross off before the majors go licking their lips.
Fantastic. Rick, what's your take on it?
Yeah, I find it really interesting. I think, look, I agree with Matt that there's going to be some opportunities, but I think you've got to really let a lot of these projects play out. The market's run so hard that you're finding it. A lot of these explorers have got pretty lofty valuations, to be honest, and so as a company looking to acquire it, they're paying really top premium on that. And Hedley makes a really good point that going through that feasibility stage, whether it's a permitting risk or a technical risk with developing the project, that time costs money. It can take an extra 6 or 12 months to overcome that technical issue or permitting issue. It could take years, and that can really destroy the value on a potential acquisition. I'm not sure that there'll be a massive rush for the acquisition, and then so a lot of those explorers run the risk, a serious risk of sort of get caught in between, that they need to keep raising money to keep doing that work and to get to that point, and then they might find that they might have to actually develop the project themselves. And so as an investor, you've got to be very careful that you don't get stuck in that trap that you see someone makes an exciting discovery and say, this is great. It might be a great opportunity in 5 years' time that you make your money, but you're not actually going to make money for the next 4, because you get stuck in that horrible orphan period that companies typically go through as they go through, that feasibility, permitting stages, all the risks associated with it. So it's something that we watch very closely and we monitor. And I think the new investors that are rushing into the space are not aware of that, and it's a major pitfall.
I think people need to keep aware of that curve that happens.
The Lassonde curve, yes.
The Lassonde curve, exactly. And I guess, Nick, that's it's that point where it starts to sort of go down again. That private equity can step in there and provide some funding to get it developed.
Yeah, that's certainly the case, Leo. But I think the original question was just in relation to surplus cash in these heady times of high gold prices and some other commodities, of course. But obviously, as a debt provider, your mechanisms in the facility often include a cash sweep, and so we're keen to see that happen as a lender, and it often will. But at the same time, we're very happy to encourage additional exploration. If you can take a 10-year life of mine gold project and all of a sudden have additional resources that are converted into reserves, and the thing will go for 15 or 20 years, or the opportunity for an expansion project if there's sufficient life of mine. I mean, we're very happy to have a good discussion with our client around that. Often we might have a modest royalty as part of the commercial terms in our facility. So both an expansion, a higher commodity price, but additional life of mine is something that we're very open to as someone who tries to provide flexibility and work closely with our clients. We're more than happy to look at those sort of discussions to happen.
Sure. Before we move on to the next topic, I just want to remind people watching that you can submit questions for our panelists. If you go down the bottom of your screen and you see the Q&A little box there, you can type in a question. Let us know your questions and I'll feed them through to our panelists. But I wanted to talk a little bit about the batteries space. We've talked a lot about gold. Battery metals have, a week or so ago, we had the Tesla Battery Day, which created a bit of interest in this sector. How are you guys doing in this space? Where are you particularly interested? Hedley?
We've always taken a view that if we're going to invest in something which is well pre-development, drill out stage, for example, you want to feel like the extraction and marketing risks are well understood. And looking at a lot of the battery related projects, across a variety of commodities over, say, the past 5 years, I've often had the feeling that the management might not be totally across what they're going to be able to sell when they come to market with a product. The sales process for some of those things are a little bit harder than when you compare it to something like gold. I mean, we could the bunch of us go out with a shovel and a pan and be mining gold. In fact, there are gold mines in my suburb that were mined 100 years ago. We could go and pan there, we could sell the gold in the street. It's easy. Things like lithium, base metals concentrates that contain cobalt, etc., a little bit harder to sell and transport to market. So we've been a little bit shy of those, but have been happy to see a number progressed. We now understand, I think, how you go about selling some of those things, but more so, I think we're also getting a great idea of, where the world economy is going as far as this decarbonisation and electrification shift. And watching the way that the US versus China will play out in that. The US has been far more self-sufficient in oil and hydrocarbons than it is in batteries at the moment. And I think that that's something that they feel that China has probably got the jump on them. China produces more solar panels than anybody else. The US is far from self-sufficient as far as batteries, and they're deeply reliant on Asian provision of that at the moment. So I think when it comes to offtake of projects, that almost shifts the risk from can you sell it to are you selling it to the right agency? So interesting place. I think we're still very early in the understanding of how those projects come to market.
Mm. As ESG becomes increasingly important for all investors, batteries, obviously, it's a good opportunity for the mining industry to sort of show its ESG credentials. Matt, AMP Capital, what's your take on the battery space?
Yeah, definitely. I mean, ESG more broadly, that actually makes up a portion of our process, and we do take it quite seriously as part of our investment process. So I think, we don't have exclusion lists or favourable lists, so we're not saying we're going to not invest in coal and oil and gas and favour battery minerals. It just means the hurdle for better ESG companies is lower to get in the fund. And that's based on a lot of data we've got, which shows that companies which manage well actually do outperform poor ESG companies quite materially over the long term. So that's kind of the background, and that's how we view things. The battery material space is very interesting because it is one that is attracting ESG money, and the macro side is that there's money flowing into ESG funds. Pension and super funds are getting more active in the space. They want to hold their managers accountable to various ESG outcomes and risks, and that's seen people move away from traditional fossil fuels into battery materials. I think it was very interesting to see a couple of months ago, Pilbara Minerals, which is a WA-based lithium producer, actually refinanced a big chunk of their debt at an interest rate of 5% versus 12% previously. And that was money coming from partly from the Clean Energy Finance Corporation at the bottom of the lithium cycle. So these are sort of the outcomes the companies in the right sectors or with good ESG credentials can get. It's actually, I think companies need to realise it's not just a tick the box exercise. It can actually lead to much better financial outcomes for them. In terms of our process, heading back to the battery material space, we do like it from that long-term ESG space. I just question how long we take to actually see a market recovery there. It seems like things are getting more balanced. You've obviously had the Europeans do good things with subsidies, and that's really kicked up demand. But there is still a huge amount of inventory out there in the battery material space to work through. Prices are probably going to stay low, I would suggest, probably for another 6 or 12 months. And then you start to think about what price lithium producers actually need to make good returns. It's quite materially above where we are now. So I think this is actually a multi-year recovery which will play out. Getting in early, it could be the right strategy if you have a good long-term time horizon. You might just need to take a few bumps in the road on the way there. So it's a space we're watching. We're getting more interested in, but we're probably not quite convinced on it yet, just from the earnings side of things more than ESG.
Rick, your thoughts on this?
We're actually more bullish than Matt and Hedley on this space. We think you can, from the recent Tesla announcement that they announced that they made two big announcements at the Battery Day, that they were investigating development of their own lithium clay project in Nevada. Now, I think that's well off into the future, but they also said that they were going to build a lithium refinery next to their proposed Gigafactory 5 in Austin, Texas. So they're actually looking to move up into that upstream part of the production to ensure that they secure supply. And so they also did a deal with announced an offtake with Piedmont, and people have been watching the Piedmont share price. It's just gone gangbusters in the last week or so. That that they've said, well, we'll source our lithium, spodumene concentrate from North Carolina, bring it down to Austin and produce the batteries. But the key thing is that they must be seeing supply constraints into the sort of the medium term to actually go and negotiate what with Piedmont was a 5-year offtake with a 5-year option to extend that. So big contracts, but long life on one of the more challenging projects that are out there was, you look at some of these other operations, and Matt picked out Pilbara, that larger producers. We think that's a better space. Now the timing for the turnaround, it's difficult to point out, and I'm not saying it's about to kick next week or next month, but I think the outlook is strong. And then we read in the paper today that Tesla's also talking to BHP about securing nickel. So why are they going around right now when you can see all this mothballed operations in terms of nickel and lithium and negotiating deals with these people? It's like unless they are concerned about the outlook, they wouldn't be doing it right now, and they wouldn't be vocal about doing it, yet they are. And so for that reason, we think now is a fantastic time to be positioning, because as we know, anyone that's been investing in resources over time, that when it happens, the uptake is very rapid. So you've got to be invested at the bottom. You don't know when it's going to kick, but that's the explosive growth, and that's when you make the money. And at Acorn, being invested at the bottom of the cycle, that's where we make our money. Then when you get to the top, there's just elements of growth that you can eke out through process. But being well invested at the bottom is the key. And so for the battery element space, whether it's lithium, nickel, and even the copper, which will be an important component in it, we think those elements in particular are really exciting, as well as probably manganese.
In Elon's sort of announcements there, cobalt, they were very keen to sort of take cobalt out of the process. Is this the end of the road for cobalt, or is that just too early?
That's a good question, and it's one that we think about a lot, because the cobalt's important in terms of providing that thermal stability to stop the batteries exploding and catching fire. So what you've got to remember is Tesla's got a market cap 5 times bigger than BHP, the biggest mining company in Australia. So and they've got really bright people there. So if anyone's going to be able to engineer these things out, these guys have got the capability to make these things happen. But I don't think it's going to happen in a hurry. But Hedley touched on this point earlier, that getting exposure to some of those commodities is very difficult. Getting direct exposure to cobalt, because the biggest cobalt producer is really Glencore, but you don't buy Glencore for its cobalt. So then there are a couple of smaller companies out there with potential, like Jervois, that could do it. And maybe they will fill a nice little niche, in an interim period. But it's very difficult to sort of look forward 5 years and say, yes, it'll still be here, yes, it'll still be important. So elements like cobalt, we're cautious on for 2 reasons. That outlook's difficult, but it's actually difficult to get direct exposure, because the cobalt is almost always a byproduct of something else. So you're really buying a nickel operation with some cobalt, or a copper operation with some cobalt.
Nick, in terms of battery materials, what is Taurus's position on that?
Yeah, Leo, it's probably not a high priority for us. I mean, we do prefer, as a debt provider, large terminal markets. Hedley spoke obviously about gold and the ability to sell doré and what have you. Coking coal is one of our favourite commodities, and obviously base metals with a preference to copper. I mean, Rick and Hedley and Matt have been speaking more from the investment side, or wearing an investment hat. And I agree with Rick; it's an exciting space. I think that when you see President Trump last week using his emergency government powers to pass legislation about the state's ability to do direct investment in critical mineral projects, it tells you that it's a pretty exciting space. And obviously there's going to be a lot of volatility going forward. Let's see how the election plays out. But in relation to China and China's dominance in a couple of these critical minerals that go into batteries. So that's going to be interesting. But again, remember, I'm speaking as a debt provider, and certainly our investors, which are now 100%, large US institutions, large pension plans in the United States, they do look for consistent markets. And from guys who come out of investment banks, we would much prefer to play in a space where we have had experience and 2 and 3 decades of experience in investing in commodities and countries that we have a lot of experience in. And so we really don't have we have no experience in providing debt facilities to the lithium or the graphite, space. We have entered into, and we've been mandated on some significant fundings for potash and mineral sands. But the critical thing, again, from a debt provider is the quality of those offtake agreements. And when I say the quality of the offtaker and the tenure of that offtake and how the pricing mechanisms are arranged. And obviously, a lot of due diligence goes into that when you decide to dip your toe into another commodity, which is outside our generally accepted large terminal space.
But you're not playing the sort of the peaks and troughs. But Hedley, are you with Rick on this? Are you getting back into the battery space while it's still cheap?
I think Rick made an excellent point there, which is that it's probably, if you're looking to pick a low, we're in the realms of it at the moment. So if you've got a long enough time horizon, it's not a bad time to be shopping for those things. The problem with lows is that you've kind of got to get yourself involved in something which has cash flow if you want to live it out, or be prepared to invest to keep it alive until such a point as it can develop itself, which will need some commodity price robustness to be able to attract the funding. So there's a couple of things to consider there, but my perspective is that Tesla is approaching people at the bottom of the market because it's a lot easier than trying to compete with the Chinese close to the top of the market or when the market is reasonably strong. So now is the best time for them to put their foot on, hopefully, cheap offtake that they can get in a strategic fashion. And look, it's a space I'd like to have a closer look at, but at the moment, it's we're still having a fair bit of fun in gold.
Absolutely. And as we look forward to sort of 2021, the Australian government released their budget this morning. Was it this morning or last night? Anyway, there's some tax cuts in there. And there's some significant sort of infrastructure spending. I think it was 14 billion on infrastructure, plus sort of 3 billion on sort of fixing roads and things like that, and providing some job creation opportunities. Plus a swathe of tax cuts. Is that indicative, do you think, of sort of global government policy in terms of stimulating the economy as we come out of this crisis? And what do you think that means for the year ahead?
If I could just jump in quickly, we saw our Treasurer deliver the budget last night at 7:30, and as you say, it was just splashing cash around everywhere. But a lot of it is directed, a lot of it is targeted. The obvious advantage in these low interest rate environments is that you can go out and borrow billions of dollars at low interest rates. And so it's all about, as the Treasurer said last night, it's all about the job creation. It's all about that infrastructure spend and housing and basically employing apprentices. But an interesting statistic, and I do think it'll form a template of OECD countries in the way that they do borrow and stimulate their economies to get the growth back in this very sort of interesting, strange year when you think we're in our final quarter of 2020. It's quite amazing how quickly it's gone, but it is amazing how many challenges we've had. And so, yes, I think this will obviously become a template. We always knew it was coming. But the Treasurer last night, Leah, did say that he's pointing for the next financial year of 4.5% growth. And he did say in that utterance that he expects China to reach 8%. So I think that augurs extremely well for most of the commodities that we all delve in.
Absolutely. Rick, how's your view on 2021 looking?
Yeah, no, we're pretty optimistic. I think it's it's going to be a few false starts in terms of, but the globally the governments need to dig their countries out of these lockdowns and the challenges that are presented to their economies. And as Nick pointed out, there's going to be big spends on infrastructure, but a lot of the governments have indicated that they don't want to pour money into the old economy, that they want to say, well, where are the growth areas in the new economy, and one of those key areas is this low carbon future, and that's again why why we particularly like that sort of medium-term outlook on those, battery metals, on those infrastructure, those sorts of things. But it also plays into gold. That it goes back to the point Hedley made really early on, that low interest rates aren't going away. Governments are drawing more and more debt to get themselves out. And you're probably going to see a weakening of the US dollar, because the euro is going to strengthen, and as China continues to strengthen. So all those elements are to me are not just positive for gold or the EV metals, these energy storage metals, but it's across a range of commodities. So we're actually very bullish on the sector as a whole.
Mm-hmm. Absolutely. Matt, AMP is probably producing some information at the moment. You're economists over there about how they see things panning out. What's your take on 2021?
Yeah, absolutely. I mean, I definitely think that global infrastructure spend is going to be a big driver in 21. We've obviously seen the first wave of stimulus, which has been cash handouts to consumers and JobKeeper in Australia and programs like that to keep people working. I think the next stage will be that infrastructure investment. I think the problem with that is just the timing of when that hits. I mean, a lot of these big ticket infrastructure jobs do take quite a lot of planning and permitting and that sort of side to actually get ready to for money to be put in the ground. So we may see a false start in terms of that just getting pushed out a little bit and the actual benefit flowing maybe a bit later than people think. Similar to the other guys, I think that the setup's very good for gold. Continued global stimulus, low real rates. I think gold gets very well supported. We're still very big in the gold space. You look at iron ore, some of the base metals, which will benefit from various stimulus packages and spending. I think a lot of that's already reflected in the prices that we're at today. You've obviously had China being a huge importer of these commodities over the past few months, as they've sort of done a lot of their stimulus earlier than Western economies, given they've come out of COVID a bit sooner. So I wouldn't be surprised to see prices stabilise or roll off a little bit in terms of some of the bulks and base metals, maybe over the next 6 months or so. But I think medium-term view, infrastructure spend should be very positive for most commodities across the board. And then, as Rick said, I think that gets followed on by low-carbon metals and materials down the track.
Fantastic. And Hedley, last word to you before we wrap up. Your outlook for 2021.
Well, it can't be any worse than 2020, can it? So I suspect that whatever your expectation is, if you base it on what you've experienced this year, you should be okay, because it's bound to be better than that. COVID isn't going away all that quickly. I mean, the experience in Australia has been that most states have managed to keep more or less a lid on it. In Victoria, it escaped quarantine and it spread through the community very quickly. And Australia is fortunate compared to places like the United States, England, etc., where it is much more prevalent. And I think what we can say about the disease is that it's going to be with society for probably longer than just 2020. I don't know how far it'll extend. And I think pinning hopes on a virus is probably, you're depending on something which hasn't been all that successfully delivered in the past for diseases which are of a similar strain. With that in mind, there's bound to be an economic hangover, and it's like a party which is just really slow to stop, which is what the stimulus is. Exactly when does the hangover cure start to kick in? Which is where Matt was going. There's a lot to spend and there's a lot being thought about deploying, but I think most governments know that if you give money to people, it gets wasted. So you need to be very careful about how you actually hand it out. And I think, a lot of the stimulus will be something which is delivered, but is delivered slowly and needs to be considered to be delivered slowly, because COVID is unlikely to be over quickly.
Absolutely. Well, it's going to be a fascinating year to come. We live in interesting times. So thank you very much, gentlemen, for your thoughts today. And I hope you have a very successful conference and get back to your meetings, which I think will be starting again in a couple of minutes. So thanks guys for joining us today.
Thank you for having us. Well done. Thanks, guys.